All right, the Canadian market has been absolutely crazy over the last 6 months, as everybody knows. It's actually going to be about since June when the first lockdown started to lift that the market started to go a little bit nuts. And that is starting to cause some inflation. Now, the experts that I'm listening to, and I know nothing about inflation, so don't talk to me about it, but they're saying that inflation will likely be short-term lived, and that will rise prices as it has been doing. And at some point, the market will correct. And the market, being real estate and everything else, will also correct. Like the whole thing, I don't know anything about stocks, but the market will correct. And what does that realistically look like? Well, I'm going to show you here using historical data. Now, I'm sure there's going to be a ton of people down in the comments, as they always are, talking about the bubble's going to burst and it's going to zero and blah, 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 blah. Yeah, that's great. You guys generally don't use statistics. I'm going to use statistics here on my screen and show you what's happened in the past. And then I'm going to use the worst case scenario from the past in order to look moving forward. Now, unfortunately, the Fraser Valley board numbers don't go back as far as the crazy inflation that happened in the 80s. And I do think the government has learned a ton about that. So I'm not going to include that here. And then I'm sure there's going to be a bunch more negative comments, but I don't really care about that. Let's look at the real numbers and run some numbers to see exactly where we may end up. But before I do that, I'm going to have to ask you to subscribe to the channel and hit that notification bell. Remember, when we reach 1,000 subscribers on this channel, I'm going to give away that blue bag of goodies back there. And please hit the like button to help us get this information out to more Canadians that are looking for this type of information. Okay, so here are the stats for HPI. And when I looked up HPI, I prefer to use HPI because it's a much more complex system in order to calculate home values, except some people apparently in the bubble bursting world refer to HPI as Franken numbers, which I thought was hilarious. But let's not use then HPI. Let's go over and use average sale price. Now, average sale price, what you see is just a mathematical calculation and it's jagged like crazy. It's really hard to tell what the overall market's doing because it can be swayed by individual months and high sales and low sales. So the next thing I'm going to do after that is I'm going to average it out by 12 months rolling. So that gives us a much more accurate representation of what the market has really done since 2005. So let me show you, this is the Fraser Valley market. If I didn't say so, I work in Surrey, BC, and the Fraser Valley. Unfortunately, I don't have insight into the rest of Canada and their statistics. There's other great people on YouTube, I'm sure, that could show you all that stuff. But I'm going to use the suburbs here outside of Vancouver as a mark of what my market is not only doing, but it's very similar in most major cities throughout the country, as long as there's not other economic factors at play in those particular cities. So let's go back to January 2005 when the numbers start. And we had an overall price. Now, this is every asset class. This is detached, townhouses, condos. The average rolling price was just under 300,000 at 293, almost 294. And then we saw a market increase. Now, that increase happened for, let's call it the better part of 4 years, all the way up until let's call it November, I think we peak out. So we go on almost a 4-year run. And it tops out at 431,945. Now that represents a 47% increase in the market over that up period, because we always talk year to year, but we don't often talk runs, like how high and how low from the peak. Because if a run takes less than a year or more from the year, it's going to skew those numbers. But that's geeky nerd stuff. Don't worry about that. So let's say the market increases 47%, which is bigger than the increases that we've seen lately, believe it or not. The market increased 47% over 4-year period. Now we hit November 2008, the financial crisis in the States. And may I say that financial crisis caused by a bunch of terrible lending, but also the recession caused by interest rates getting ratcheted up overnight. And that is actually the potential that I'll get into on another video, but that is the potential for any market correction within Vancouver or all of Canada, is if the government gets involved and ratchets up interest rates. Not that they ratchet them up, that they ratchet them up overnight or too quickly. All right, so let's say 2008 November, we go up to 431. Now we're going to see a downturn because of the financial crisis. And that downturn, get this, lasts until August of 2009. So it lasts for 9 months. Big bubble, the biggest bubble bursting that I've seen in my career happened over a 9-month period after a 4-year run. Now, those properties that were 430 go down to $416,000 roughly, making a minus 3.5% off of the peak. Now let's go from August 2009. We go on another big run up, and the market seems to peak out about February of 2012, up at $504,000, almost 505. So that's, let's call it a 2.5-year run at that point, almost a 2.5-year run. And that is another 21% increase, believe it or not. So then we kind of peak out in the market. And this is when we were starting to sell condos for much less than people were buying them for in 2010. The market kind of goes down, and it goes down for a period of 14 months, all the way until April of 2013, when it bottoms out at 479. Right, so we've now seen a 14-month decrease, and that decrease included a maximum of 5% off of the overall market. Let's keep going. Now we're going to go on this crazy 3.5-year run. So this is a similar run to before 2008, and the market takes off. Now this is where foreign buyers were apparently the big cause of the problem. And I think in downtown Vancouver, that is definitely the case. There was lots of foreign buyers coming in because they saw safe investment within the Canadian real estate world. And that number takes off, and it takes off all the way until December of 2016. Now, the reason for that is previous to that, the government had brought in a foreign buyers tax, and that scares everybody off the market for a little bit. But that run went all the way up to almost $675,000, representing another 40% gain in the overall market. Now we eliminate all of the foreign buyers, and again, I'm going to come in here, and the bubble bursters are going to say they just started buying other stuff. Well, that they are exempt from some, foreign buyers are exempt from some forms of real estate. However, they were not buying mansions anymore on the west side of Vancouver, which apparently caused the whole problem in the first place. So we see now a dip from December 2016 when that finally irons out. Now, remember, the change actually happened in August for foreign buyers, but the dip didn't show in the numbers because these are rolling numbers until December. And then we go on a downslide, and that downslide, believe it or not, lasts for 4 months. And the decrease in that 4 months was down to 656. And you're going to see here that represents a 2.7% decrease over a 4-month period. And then, you know what? The market's so good, everybody stops being scared about foreign buyers, and it takes off again. That run this time is going to go all the way. Now, again, let me say that was a 4-month run. Now we're going to go up to a 1.5 of kind of craziness. We see the townhouses and the condos taking off over 2017. We go for a 1.5 of a run, up another 13% in the overall average price, up to $747,193. And then at that point, just again, these stats are all going to be slightly behind just because of how statistics work and reporting. We're going to now see the result of the stress test being put in. So the stress test says, no, you're not allowed to qualify for the actual rate you're going to get. You have to qualify above that. By the way, I'm going to go on record here saying that's a very good thing, and that's actually going to be something that saves the Canadian real estate industry from any big crashes in the future. So you may hate Trudeau and his party. This was a good move. All right, so let's now go on to our downturn as a result of the stress test. We're going to go for 1 point. What are we here? We're going to go all the way down to the bottom, November 2019. So let's say it took about a year, and we're going to go down from 747 down to 715, almost 716. And then, well, things go crazy. Now, we did see the dip of COVID, but that dip barely even registers. It's more of a flattening here because the market was, remember this, already good. Before those interest rates were hammered down, the market was already taking off in January, February 2020. So now we take that next, let's call it another year run. Oh, even more than that, year and a half run now, and we are up at 905. So we have seen these little dip back, and then these crazy big long runs, which is what the market tends to do. All right, so let's now apply this. Where does that actually leave us moving forward, and what are our worst case scenarios? Well, worst case scenario is for some reason the government steps in and ratchets up like they did in the 80s, the interest rates way too fast. And if they do that, well, at that point, there's for sure going to be fear go into the marketplace, and the market will stop and the numbers will come back. But we do find that when that happens, over time, it will actually still intend to increase. But let's say the BC government, or sorry, the federal government of Canada has learned their lesson from the 80s and doesn't want to go ahead and ratchet those interest rates up too quickly. Now, I think they should ratchet them up, and they're planning on actually ratcheting them up earlier, which is, again, going to be a good thing. They're talking about a year and a half from now. If they do that, what we're going to see is for sure a slowdown in the market. And I think we're already seeing a slowdown in the market due to threshold of price. Like buyers just can't afford anymore. Here's what I thought would be super fun. Let's take our biggest downturn from this point at 905. Let's take our largest downturn of 1.5 years over since 2005. Let's take our largest downturn of 1.5 years, and let's say it takes a year and a half to go down also by our largest drop, which was 5%. So over the next year and a half, so let's say by, I don't know, almost December 2022, the market drops from 905 down to 860. So we're going to see a 5% drop. Well, then likely, if we look historically now, what we would see at that point, and there's going to be immigration and all this other stuff coming in, probably driving these prices higher, but that's an opinion of mine. Now we're going to be down for a year and a half, and then we're going to see another run. Now let's take the longest run. So it took the longest time and the lowest increase that we've seen. So 13% is the lowest increase we've seen in any of these bumps. And we're also going to take the longest time to do that, which is 4 years. That will actually take us up to 972. So if the market crashes today, no, I don't want to say crash, because again, there is always that possibility that they do actually ratchet up interest rates massively. And if they do that, it's usually a result of not doing it soon enough. So I'm glad to hear that the government's actually going to step up their plan and make it a little bit faster. But let's say, for instance, the market crashes today and we go down to 860, we go down 5%, and then we actually end up going up again, 13% only. If you bought a property today, in 5.5 years, it's going to be worth $972,000, and you're going to be ahead. This is how the market works. This is the actual statistics from the past and applying them moving forward. So if you bought a property today and the market does crash or slow down, which is more realistic, likely you will have to be in that property for about, well, let's call it about 3 to 4 years to actually get your money back to the same spot. And at 5.5 years, you're actually going to be ahead. So I hope this has all made sense to you. It's kind of long-winded. I'm a bit of a stats geek, but I think this is a more realistic projection of what the Canadian marketplace will do over the next few years, should it actually slow down. And it is showing signs right now of slowing down due to people maxing out on their prices, but also now inventory coming to the market. I hope this all made sense to you. I hope I didn't bore you to death, but if I did bore you to death, you're not here. Thanks for watching. Please remember to click subscribe. It could win you that bag of goodies back there. Hit that notification bell so you don't miss a single Canadian real estate update. And please hit the like button to help us get this information out to more Canadians that are looking for this type of information. Thanks for watching, and we'll see you next time.